Hello, my name is David Andolfatto. I'm with the Research Division here at the St. Louis Fed, and I'm speaking to speakers here who are partaking in our first annual St. Louis Advances in Research Conference. This afternoon I have the pleasure of being joined by Amir Kermani of Berkeley University, who has spoken on a paper with the title Unconventional Monetary Policy and the Allocation of Credit. Welcome, Amir. Why don't you just begin by telling us a little bit about your paper, what it's about?
Okay, thanks for having me. So this paper is all about the channels through which these unconventional monetary policies are affecting the real economy.
So by unconventional monetary policies, what are they?
So
Let's start there.
In particular, what we are interested in is basically the larger scale asset purchase programs. What are these programs? The typical conventional monetary policy was that the Fed was announcing, okay, this is the Fed funds rates, we are going to reduce that, increase that. So that was the conventional monetary policy. Okay. By 2008, late 2008, we ran out of that, so we basically hit the zero lower bound, so there was nothing else we could do about that. Okay. So then that was the time that Feds started purchasing long-term assets, basically, and this way they were reducing the long-term interest rates. So, and then different Feds in different, so the Federal Reserve in the US did it different ways in different rounds of it. So during the QE1, they mainly purchased mortgage-backed securities. During the QE2, they mainly purchased just long-term treasury. Then we had a period of maturity extension program. They did a little bit of both of them. During QE3, it was much more increasing, their purchase of mortgage-backed securities. So even within the US, they do it differently. But if you think a little bit more broadly, in Europe, for example, they even purchase covered bonds, asset-backed securities, financing Greece bonds, which you can think that this is a different kind of things. But or in Japan now, they are even purchasing the stocks of the firms or REITs. So it can include purchase of many different type of assets that the Feds or the central banks are not doing that usually in normal times.
So what was unusual was basically the central banks are printing a lot of money and using this money to purchase various types of securities, and at various points of time, the size and composition of these securities has changed. And so what is it that we don't know about these programs? What's motivating your research here?
So the main motivation here is this, that despite the very importance of these programs and the different ways that these programs are done, there's very little both the theoretical work and the empirical work that is supporting that. This basically shows what are the channels through which these are affecting the real economic activity. And understanding the channel is crucial in understanding what's the best way of doing these unconventional monetary policies. So, for example, if it's the case that the effect of purchasing treasury versus the effect of purchasing MBS is very different, you could be in a situation that you are doing a lot of these larger scale asset purchase programs, but it doesn't affect the real economic activity. Most of the effect is just going to the asset prices, maybe even increasing the inequality. So there are all of these very important questions that at the end of the day, the main issue is that you have to know what are the mechanisms through which this is affecting the real economic activity. Otherwise, you may do a lot of these larger scale asset purchase programs without having any real effect on the real side of the economy.
But I guess the conventional story, when you hear, say, Bernanke explaining at the time, was these large scale asset purchases were designed to increase the price of these securities, increase the price of treasuries, increase the price of mortgage-backed securities, MBS, the effect being to lower the real interest rate, the effect therefore, theoretically at least, to stimulate spending.
Exactly.
What's wrong with that story?
So exactly. That's exactly where our paper is coming. So Bernanke, especially also in his book, he's defending all of these, the quantitative easing programs, thinking about this, something that in the paper we call the broad spillover channel. What is the broad spillover channel? Exactly as you explained. The Fed is going out, purchasing these long-term assets. This is reducing the long-term interest rate. This is going to increase the supply of assets that are related to these long-term assets. So what are those? Mortgages, stocks, all of these things. So in his view, the only thing that matters is that the Fed should go out, purchase long-term assets. That's going to help the economy. What we find in the paper is slightly different, that the way that these unconventional monetary policies are working, especially during the QE1, that the banking sector wasn't in a good shape, is that it's through a very narrow segmented channel. So one way to understand this is that you can think about an economy that you are just dropping the money on the economy and then it is spill over to all sectors of the economy. Or you can think about the environment that you have the fly paper effect, that the money is dropped somewhere and then it stays there. It doesn't spill over to the other sectors. And this is exactly what we find during especially the QE1 period and the QE2, that the Fed is purchasing mortgage-backed securities. This increased the supply of mortgages, but with very little spillover, for example, to the REITs, to the other kind of mortgages that the Fed is not purchasing. So, for example, talking even with the people in the industry, so so these people were saying that, yeah, the rates were very low, but we couldn't borrow at those rates. None of us could borrow. So it's true that they reduced the interest rates, but this doesn't necessarily mean that this increased the supply of all of these. All of these.
Okay, so let me get this. If I get this straight, so let's take QE1 and QE2. They were both large-scale asset purchase programs, exactly. So they both injected money into the system in some manner, but that the composition of the assets purchases differed across the two episodes. In the first episode, it was largely mortgage-backed securities, Treasury guaranteed mortgage-backed securities, I guess. And in the second episode, it was mainly treasuries.
Exactly.
Your point is it matters. The composition matters. And Bernanke would say the composition doesn't matter to a first order, but you're saying it does. And the evidence is
so the evidence,
found.
So we have two pieces of evidence related to that. So one is that even during the QE1, in which the Fed purchased mortgage-backed securities, not all mortgages were eligible for the mortgage-backed securities that the Fed purchased. In particular, Fed, as you mentioned, only purchased mortgage-backed securities backed by the GSEs, which at the time they were under the government conservatorship, which means exactly they were owned by the Treasury. So in order to be eligible for the Fed purchase, your loan size has to be below the conforming loan limit. Your LTV has to be below 80%.
Loan to value ratio.
Exactly. So what we do, in the first part of the paper is basically looking at the differential reaction of the jumbo part of the market, which wasn't eligible for the Fed purchase, and the conforming part of the market. And then what you see is that the conforming loan mortgage originations increased by 170% after the Fed started these mortgage-backed security purchases. Jumbo mortgages only increased by 30%. We don't see this differential effect during the period of QE2.
I see. So this flypaper effect is evident in the fact that the assets that the Fed targeted became favored. You saw many more originations coming from this asset class. That would not have been the case if we had the view that these things just spilled over the way Bernanke.
Exactly. And then, another piece of evidence that we have that, you can also see this even from the prices on the secondary market. After the first announcement of the QE1, which Bernanke talks about, it's late November of 2008, Bernanke says that we are going to purchase $500 billion of mortgage-backed securities. The spread on mortgage-backed securities declined by 70 basis points. The spread on the Treasury only declined by 20 basis points. So you can imagine that if the Fed was purchasing Treasury during the QE1 instead of mortgage-backed securities, the decline in the interest rates of the mortgage-backed securities would have been much less than what happened because they purchased mortgage-backed securities. Yes. But that's not all the story. So, because as we talk about it in the paper, all of these prices are conditional on the person getting the mortgage. So a more informative number to look at is the probability of refinancing for the households or the quantity of refinancing. And you see that if you look for the period of especially the QE1, the amount of refinancing that you see that happened was beyond what you can predict with just the decline in the mortgage rates. Mm-hmm. So for example, if you make a model that is predicting that what's the refinancing reaction of households to a coupon gap. A coupon gap is the difference between the rate that they already have on their mortgage and the rate that they could get on the market. If you just estimate that for every household and then put it in the regression, estimate the coefficients, the amount of refinancing that you see is twice larger than what you could just predict from the coupon gap. So that's another thing to think about it, that at the time these quantities were very much informative. And I think the fact that Fed during the QE1 purchased mortgage-backed securities was a very smart idea. Housing market at the time was one of the most important markets of the economy. The flow of capital into this market was super important. If there was any disruption in the flow of money into that part of the economy, the whole economy perhaps would have been in much worse shape. Fed purchased mortgage-backed securities. I think, basically our result is showing that was a very important policy at the time.
You say smart, some people might say fortuitous, but in terms of, so what would be the broad policy implications you would say that comes from your work? I know you've just touched on some of it. Maybe there's something else. What's the takeaway here in terms of policy?
I think there are two main takeaways from this. This paper. So there's the first part is exactly what I told you, that it really matters what the Fed purchased, and the way that maybe one way to think about it, that if, for example, a central banker wants to decide, okay, whether I should buy this asset or the other asset, you should think about this, that, okay, which one is a more binding constraint for the, in your economy? Is it that the households cannot borrow from the financial sector, or is it the firms cannot borrow? Or is it that, for example, if you are, for example, a Greece government, you cannot sell your bonds to the market, maybe now you need some rescue. So you really have to find out what is the most constrained part of your economy, and you may want to try that. So this is a little bit saying that the Fed is allocating credit, but we are showing that, in fact, that's the channel through which QE is working. So you cannot deny that you are going to have some allocative effect. Right. Let's just have it in a smart way. Sure. But then the second implication of the paper is this, that because at the time that the Fed was purchasing all of these mortgage-backed securities, these are the ones that are backed by the GSEs, and GSEs had their own policy, not coordinated with the policy of the Fed. In particular, one of the main policies that they had was that the LTV should be below 80%, for example. Less or equal than 80%. What that meant that all of these regions with the hardest hit area, all of these hardest hit areas with a lot of households, underwater households, they couldn't benefit from all of these actions that the Fed was doing. So it was something worse than the helicopter drop of money. It was the drop of money on the people that needed the money, slightly less. So the second very important implication of the paper that we basically use a lot of household level micro data to show this point is, it really matters that you have a complementarity action between the mortgage policy, or in general you can call it the macroprudential policy, and the monetary policy itself. So at the same time that you are doing all of these unconventional monetary policy, you have to relax some of the constraints on the lending market. And in particular, for example, in the paper we show that, for example, if they were relaxing the LTV, the loan-to-value ratio requirements, there would have been at least 3 channels through which it would have helped the aggregate economy. So the first one is that the people who needed the money the most would have, we would have seen more refinancing of the people who need the money the most. So that's the most direct channel. But we also document 2 other channels. So the second channel is the cash-in channel. So what is the cash-in channel? Because the LTV requirements were very strict, so these 80%, if my mortgage, for example, if my LTV was 90%, but I wanted to benefit from all of these lower interest rates, the only option that I had was to save a little bit more money, take away some of my liquid assets, reduce the balance of my mortgage to be able to refinance my mortgage. But then this kind of refinancing most probably, it's not obvious that it's going to have any positive consumption effect. Maybe it even have a negative consumption effect. So if we were relaxing the LTVs, we would have had much less of this cash-in refinancing. And then we also have some people who are doing a cash-out refi, meaning that when they want to refinance their mortgage, they're also extracting some more money, which then they can use for their own consumption. If we were relaxing the LTV requirements, we would have also more cash-out refis.
You estimate the effect on all 3 channels through your model?
So this is what now we are working on it. So we still don't have the exact number.
So it sounds fascinating, first of all, and it sounds like the GSE should have a state contingent LTV policy.
Exactly.
So that's very interesting. Thank you, Amir.
Thank you.